A trading algorithm can generate consistent, measurable profit and simultaneously be mathematically disqualified from ever touching real capital. This specific failure state occurs when a model accurately picks market directions, but has absolutely no idea how to price its own certainty. To understand exactly how this contradiction happens, we ran a direct test on Polymarket's 5-minute Bitcoin up-down prediction markets. The environment is rigid. Predict if the price of Bitcoin will close above its opening price at the exact end of a 5-minute window. This diagram illustrates our incumbent baseline, geometric Brownian motion, a century-old math equation assuming normally distributed returns. Pitted against it is Kronos Small, a modern 24 million parameter foundation model trained on global exchange candlestick data. Intuitively, a modern artificial intelligence trained on millions of real-world trading patterns should easily dismantle a theoretical equation from a century ago. Under strict testing conditions, the foundation model failed. When forced to calculate the exact probability of an outcome, the modern AI could not mathematically outpredict the classical Brownian baseline. Yet the data logged during the simulation revealed a massive inconsistency. Despite losing the mathematical test, the foundation model generated a higher hypothetical net profit across the exact same set of trades. This yields a direct paradox. We have a single algorithm acting as a superior operational trader, while simultaneously failing as a probabilistic forecaster. Resolving this specific contradiction is the barrier between building a robust algorithmic system and handing over real capital to a mechanical illusion. The raw data set for this test consisted of 497 paired trades, all executed on Bitcoin prediction markets by an open-source paper trading bot. To test the models fairly, we reconstructed the exact context leading up to each trigger. For every single trade, the algorithms were fed the 60 minutes of open, high, low, close, and volume data immediately prior to execution. We arranged all 497 data points chronologically and sliced them in half. The first in-sample half means nothing. Models routinely memorize past data to create artificial track records, known as curve fitting. True edge only exists if it survives the unseen 249 out-of-sample trades. Without strict chronological separation, quantitative analysts will inevitably trick themselves into deploying broken systems, effectively watching their models curve fit the past in slow motion. To grade the probability forecasts, we rely on the Brier score. This standard mathematical metric measures the squared error between a model's prediction and the actual outcome. Lower is better. On the out-of-sample trades, the foundation model scored a 0.189. The Brownian baseline scored 0.188. The difference is 0.0011, a gap so small it falls entirely within the margin of statistical noise. They tied. Log loss is the ultimate judge of model confidence, heavily punishing algorithms that claim high certainty on completely wrong predictions. The baseline scored 0.567, but Kronos scored 1.080, taking double the damage. It makes absolute, confident predictions in the extreme tail ends and misses the mark entirely. Purely as a mathematical forecaster of probabilities, the foundation model disqualifies itself through statistically punishable hubris. If we pivot away from theoretical probability, we can examine the operational data through a hypothetical profit and loss counterfactual. We calculated the bottom line if the trading bot had actively used each model's signals to trigger real fires, applying the exact same edge margin and standard risk gates it runs in production. The Brownian baseline triggered 279 trades, achieving a mediocre win rate of 49.1%. Comparing the baseline against the foundation model, Kronos was far more selective. Firing only 201 times, it achieved a dominant 60.7% win rate. This translates directly to counterfactual dollars. The baseline generated $465, while the foundation model cleared $538. By the operational metrics of hit rate and bottom-line profit, the mathematically disqualified model is undeniably the superior trader. This Cartesian graph maps the model's overconfidence. A perfectly calibrated model sits entirely on this 45-degree diagonal line, but Kronos breaks this calibration. Predicting a 2.4% win chance, it actually wins over 20%. Predicting an 84% chance, it succeeds less than 70. This resulting S-curve proves the model can accurately pick the correct direction of the market more often than not, but it completely miscalculates its own accuracy at the extremes. This specific brand of overconfidence is a fatal flaw for automated risk management, and it fully explains why a profitable hit rate still yields a disastrous log-loss score. The value of an algorithm relies entirely on the broader system architecture it gets plugged into. The design of the system dictates which scoring metric actually matters. This flowchart illustrates a fully probabilistic system. Raw probability outputs are used to calculate expected value, sizing trades against market-implied prices. Deploying this foundation model here is dangerous. Its poor calibration will miscalculate risk, over-leverage, and ruin the account. An alternative deployment is an ensemble system. Multiple models act purely as directional analysts, voting on market direction without calculating odds. Here, the foundation model's 60% win rate is highly valuable. With the broader system handling risk sizing, the model's poor calibration becomes entirely irrelevant. It is critical to note that this test evaluated one specific AI checkpoint on one sub-minute crypto market. The data does not prove the classical Brownian math is universally good, it only proves that it was less poor in this specific context. Honest backtesting requires explicitly separating a model's operational ability to pick a direction from its mathematical ability to honestly price probability. Confusing the two is a reliable way to lose real money.